Ever wondered what bonds are and how they work? Well, wonder no more. Today, we're diving into the fascinating world of bonds, a type of financial instrument that plays a pivotal role in the global economy. Bonds, in the simplest of terms, are debt securities. When you buy a bond, you're effectively lending money to the issuer. This issuer could be a government, a corporation, or another entity. In return for this loan, you receive periodic interest payments, and once the bond matures, you get back the bond's face value, also known as the principal. But who exactly issues these bonds? Well, various entities issue bonds. Governments issue what we call government bonds or treasury bonds. Corporations issue corporate bonds, and municipalities issue municipal bonds. Now let's talk about face value or principal. This refers to the amount that a bond will be worth when it matures. It's also the amount that you, the bondholder, will receive back when the bond matures. So if a bond has a face value of $1,000, that's what you'll get when the bond matures. Then there's the coupon rate. This is the fixed interest rate that the bond pays to you, the holder. It's usually expressed as an annual percentage of the bond's face value. For example, a bond with a face value of $1,000 and a coupon rate of 5% will pay you $50 in annual interest. Another important term to understand is maturity date. This is the date when the bond reaches the end of its term, and the issuer must repay the bond's face value. Maturity dates can range from a few months to several decades. The yield on a bond is the overall return you can expect from the bond, taking into account its purchase price, coupon rate, and the time remaining until maturity. Bond yields can fluctuate based on market conditions and interest rate changes. Liquidity is another key characteristic of bonds. Typically, you can buy and sell bonds in the secondary market before their maturity date. However, the price of a bond in the secondary market can change depending on interest rate variations and other factors. Lastly, bonds often receive credit ratings from credit rating agencies. These ratings assess the creditworthiness of the issuer. Higher-rated bonds are considered lower risk, while lower-rated bonds, sometimes referred to as junk bonds, carry a higher risk but offer potentially higher yields. Investors often buy bonds for income generation through coupon payments and capital preservation. While bonds are generally seen as less risky than stocks, they're not entirely risk-free. Elements like interest rate fluctuations and the risk of the issuer defaulting can impact their value. In conclusion, bonds are an essential part of the financial landscape, offering a way for governments and corporations to raise capital and for investors to earn income and preserve capital. They come with their own set of characteristics, benefits, and risks. So, as with any investment, it's crucial to understand what you're buying and how it fits into your financial goals and risk tolerance.